Shyam Srinivasan joins us now, Managing Director and CEO with Federal Bank, to talk about how things have transpired for the quarter gone by. Remember, Federal Bank numbers came on Friday, and what a bazooka numbers. The stock reacted, upgrades have come in, CASA is looking strong, core growth seems to be back. Shyam, NIMs growth at 10%, NIMs at 3.3%, 67% of your book floating. How are you guiding for NIMs and NIs growth in FY23?
Firstly, thank you for having me. I want to just give some introductory remarks. The quarter that went by was really solid, as you may have observed, on all counts, whether it's net profit, operating profit, growth on sequential basis, growth on a Y-on-Y basis, diversified across the spectrum of the book. So it's been a very encouraging and a rewarding quarter. In specific to your question around NIMs, at the start of this financial year, we had said the full year NIMs would be somewhere in the 325, 327 range. We are now encouraged to revise it upwards closer to 330 for the full year basis, because first quarter was lower. So the second quarter was good at 330. We think somewhere in the 330 or a little above for the coming quarters, which means the full year average would be 327 to 330.
Up 2%, and you continue to broadly guide the same net interest margins. Do you see cost of funds going up?
No, I said the full year blended will be closer to that number, which means it makes up for one quarter at 320, right? So Q3 and Q4 may be higher than the 330, but I said full year blended will be somewhere in the 330.
Right.
But yes, you're right. It is certainly, you can visualize Q3, Q4 and the periods ahead. Cost of resources will go up, but so will the cost of lending. I mean, the price of lending, right? So to that extent, it may balance out. That said, the full year number would be, like I mentioned, somewhere in the 330, which essentially means a strong Q3, Q4, and weights out whatever opening disadvantage we have.
Right. So, Shyam, how is it that you see the competitive intensity on the deposit side, and where does Federal Bank stand out right now? How comfortable are you?
I think deposits has been our strongest suite, right, forever. And it's largely granular, and we don't rely much on the bulk deposits, as you may have observed, right? Large part, 93% of our book has been retail, and it's always been the case. So I think our ability to garner deposits, so yes, we have to be competitive in term pricing, which we are and we will, but we are a very dominant player in the remittances market. And as remittances are going up at rupee at 82 or so, we're seeing a material or a meaningful flow in increase in remittances. And as remittances go up over periods of time, they translate into deposits as well. So I think our deposit growth will certainly match our requirements of credit growth. We are looking at growing credit in the high teens, sorry. And deposits will match meaningfully on that. I mean, I'm not suggesting it will grow at the same rate, but well enough given our ability to manage CD ratios somewhere in the mid 80s, we are good for deposit growth, and a large part of it is granular and not bulk. And so the opportunity to grow deposits continues. We are expanding our footprint. Our fintech partnerships are going well. So combination of this should help us get the deposit growth required to match our credit needs.
Right. Tell us a little bit about your slippages then, because the trends have been low for you and you seem very comfortable about the book. But what is it that you're doing differently in this credit cycle?
As all of us know, credit books reflect long periods of credit underwriting. It's not what we did yesterday or what we do today. We've been conservative for very long, and our book is largely secured. So I think we have configured ourselves to grow at 18-20% credit and have the underwriting, collection, overseeing capability to ensure that the credit quality is well managed. And I do believe for many quarters, our credit costs have barely ever crossed 50, 60 basis points in a long period of time. And I think that will sustain. So it's the shape of the book, the discipline around underwriting, and most importantly, the collection capability that we've built around it. So we have not been very adventurous in lending to markets or segments that we are not extremely familiar with. So as a combination of that, I believe our credit book should hold. Even through COVID, they have held out well. There will be pockets of challenges, but I think it's within the guidance of 50 odd basis points of credit cost, which we sort of often talk about.
Okay, Mr. Srinivasan, your stock has also outperformed the other benchmarks in a solid fashion, up 50% this year, and that's been backed by the steady improvement in your fundamentals and performance as well. What would you attribute as the primary reason of this outperformance this year?
I often sort of keep away from commenting on the stock price. We have only control over the performance, and I hope that reflects in the stock price. Yeah, I'm happy to see some uptake, but I still think we haven't been rewarded as well as we should for the performance we've done, and I'm hoping we will continue to perform, and investors will benefit by our performance.
Let's talk about the advances side as well then, Mr. Srinivasan. What are your key areas of focus going forward? And in terms of the medium term, what kind of growth guidance could you give us?
I think you may have observed our growth, all our businesses sequentially grew 5% or more. That's annualized run rate. Most of our businesses are at 20%, but some businesses like commercial vehicles, credit cards, gold and business banking, which are the relatively higher yield products and newer to our portfolio, are growing at a very healthy clip. The base is very low. So they are growing at, some of those businesses are going 40-50% annualized. So our business mix is fairly diversified. Within those portfolios, we've introduced new products like credit cards, commercial vehicles, parts of commercial banking and business banking segments that we're going in new. Gold, of course, continues to do well. Microfinance. These are businesses which were, really great, sowed the seeds just before COVID. And we had cooled off during COVID. We didn't want to take too many courageous calls then. As we see COVID ebbing, we have stepped these businesses up. So as a blended outcome, we're seeing gains across. And I do want to believe that this run rate and this mix will hold, which is why we're guiding for somewhere in the very high teens as credit growth for this FY. That's the line of sight we have. As we get into calendar 23, we'll see how the next year we shapes up. But right now, we are quite confident that the guidance that we've offered around high teens should be very positive across the spectrum, across these product categories.
And the environment, your capital adequacy ratio is now below 14%. Any plans for a fundraise?
No, I think this is before we put back or plow back the profits of this financial year. So as we end March 23, we do think we will be close to back to 14. And our internal thresholds are somewhere 13 or below for capital raise. So I think FY24, sometime early FY24 should be the next option, but nothing for FY23.
Right. Since we have you, Shyam, need some clarification. There's so much speculation over takeover. Are there offers? Would you consider? Put everything straight on the record for us.
I think, firstly, I did mention, or we made an exchange release. This is speculation and there's no conversation at all. But I have to say that for many years, I know we've been talked to as we'll be taken over or we'll be taking over. In all my years, I've heard this once every year. So I would just discount it and move on. We are steadfastly focusing on performance. And I do believe we have a long runway to perform and continue to do well. So I have no other comment to offer other than to say that this is complete speculation and just rubbish it.
Okay, Mr. Srinivasan, we'll let you go on that note. Thank you so much for joining us and talking to us about your numbers as well as growth outlook.